So the process we used is called the three-step analysis process. Three steps, the first one being the baseline, the second step being the surprise, and the third step being the bigger picture. Now let's start with step one. For step one, you are trying to establish what the baseline expectations are for the event that you are preparing for. Whether it's an economic data point or a central bank policy decision or a geopolitical risk event, it doesn't really matter. The process is always the same. Now, you need to analyze what the markets are expecting from the event. Now, this baseline is a very important step because if you don't know what the markets are expecting from an event, then you won't be able to figure out what needs to happen to trigger that directional volatility, what needs to happen to surprise the markets. Now, this baseline step includes looking at things like what the markets have priced in. So if it's a policy decision, looking at interest rate markets. So if you compare that to our preview we did yesterday for something like the RBA, for example, we looked at what STIR markets was pricing in going into the event. That's very important. If you're taking a look at things like economic data points, of course, yesterday we traded the ISM manufacturing PMI. So that means if you assess the baseline, it means that you're basically assessing what the markets are expecting from this event in terms of the actual data. Are they expecting a lower than prior print? What is the minimum and maximum expectation showing us if that data is, of course, available for that specific print? So this is a very, very important step. As part of this step, it's also important to assess what pre-positioning for key assets has been going into it. That'll give you a very good additional layer of analysis. Seeing how markets have been, actually pricing in specific outcomes can tell us a lot about the probability of having things like a buy the rumor, sell the fact reaction. If markets are aggressively pricing in a very bearish or bullish outcome, it usually raises the bar for the actual event to then be able to surprise the markets even more bullish or even more bearish compared to what has already been priced in, because at that stage, there's arguably already going to be a lot of negatives and positives priced in based on the expectations. A very good example of this, Abu, was looking at the way that markets reacted on the back of that prior CPI print we had out of the US. Remember, heading into that CPI print, so this was the CPI print, heading into that event, we had equities moving higher, precious metals moving higher, the dollar moving lower, yields moving lower, all in anticipation that inflation would slow, that inflation would put in a more definitive peak. And what we got is the exact opposite, right? So we got the markets actually seeing a reacceleration in inflation, which saw a very, very fast and aggressive repricing against what the markets had been pricing in going into the event. So the pre-positioning is a very important step as part of that first step analysis. Now, taking a look then at the second step, that's where you analyze what can surprise the markets in terms of the actual outcome. Now, for you to do the second step correctly, you need to start with the right baseline first, as we mentioned. If your baseline expectations is incorrect, then you won't have the correct scenario planning for what outcomes will surprise the markets. So based on what markets are already expecting and already pricing in for the event, the second step then is figuring out what needs to happen to underwhelm or overwhelm the markets. Now, this surprise step is where you build out the best or highest probability surprise outcomes that will give you a very clear edge to create a decent amount of predictable directional volatility. Now, you can find really good examples of this in literally all of the video previews that we do through the week, where we highlight the biggest surprise outcomes that could trigger the base tradable opportunity. So again, if you take a quick look at yesterday's previews, the one we did for the RBA and the one we did for the ISM manufacturing, you'll find good examples there. In both cases, we had a big enough surprise to trigger very predictable directional volatility. For the ISM, we knew that there was a higher probability for upside in equities if we got a Goldilocks print or a miss across the board. We, of course, got the miss across the board. And for the RBA, we knew either a 25 or a 50 basis point hike would have been able to surprise the markets based on the 38 basis points that was priced. So you were either waiting to see markets pricing in more basis points or pricing out some basis points. And that would have led to a very predictable directional volatility, which of course we got today. So very good examples if you just scroll through the prior videos. In terms of step 3, that's where we assess the bigger picture. This means analyzing how any of these surprise outcome scenarios that you've built in step 2, how that will impact the bigger picture for the relevant economy or security that you're trading. So for example, yesterday's ISM PMI saw a surprise with a miss in the data across the board. Now, our analysis showed that a miss, even though it wasn't our preferred reason for trading equities, a miss would have been enough to see some upside in equities. Now, there's of course no guarantee that markets would react that way, of course. It's all a probability assessment. But our analysis said that, hey, if we get a miss across the board, that would give us a higher probability for upside in equities based on the baseline we discussed in the preview. Now, either if we doesn't matter what surprise we got, neither of the possible surprises that we looked at would have been enough or been able to change the bigger picture view for either the US economy or the relevant assets like the dollar or equities or yields. None of those surprises we looked at would have been enough to change that bigger picture view. Now, if any of the surprise outcomes isn't enough to surprise that bigger picture view or change that bigger picture view, then it means that our trade isn't going to be a big medium-term swing trade in line with a strong fundamental outlook. It's literally going to be a short-term trade, just looking for a little bit of a directional volatility move like we got with equities yesterday. If any of the surprise outcomes is enough to actually change the bigger picture view for the economy or the asset that you're trading, then the trades could have a lot more room to run. And that will, of course, change the way that you consider where you place your stop, what your risk tolerance will be, and what your overall conviction in the trade will be, etc. So what I like best about this process, Abu, is that it's simple, it's repeatable, and it's really effective. It's a really effective way of approaching the markets. Now, if you watch through the video previews we do, what you'll see is that we use this framework in all of them. And the best way to learn this is really just by doing it. So what I would encourage you to do is start using this process for incoming risk events, and then only watch our previews after you've done your own analysis for the event to see where ours differs from yours. And so doing, just keep on improving on the process and getting used to it in that way. Now, and also if you have access to the analyst chat, you can always just send me your take of the incoming events in there, and I can take a quick look and just guide you with a couple of pointers and tips, etc. Now, having said all of that, a lot of our subscribers just don't have the time to do this type of detailed analysis for risk events. And that's why we have the video previews available to basically do all that heavy lifting for you already. So whether a subscriber doesn't have the time or simply just not the confidence or skills to be able to do this type of research, we basically have you guys covered by doing that already. So if you have the time to do this yourself, then that's awesome, and I would definitely encourage you to do it. But if you don't, you will have the video previews there as always to help you on that already. And we do previews for all of the big events, for all of the major ones where we think we can see some decent amount of tradable volatility. So we'll always have your back there in terms of doing those video previews. So I hope the video has been helpful. Abu, any other questions, don't hesitate to let me know.